Hey everybody, Mike DeSepoli, Heritage Financial Advisory Group. Welcome to the Heritage Market Pulse for Friday, May 6, 2022. Hope you're all having a great week. Just a dizzying ride for investors in the market this week. Extreme volatility, very big trading ranges. But at the end of the week, more was said than was actually done as the market basically went out this week where it ended last week. So I know if you looked at the market midweek, that would be anything and everything but what you would expect. However, when we look at the volatility and how extreme it's been, there's certainly being a lot of a pressure applied to investors right now. So let's talk about, we have a lot to cover. We really want to fit a bunch in here. Have some questions I want to address from folks that have called, reached out, sent emails, etc., as well as some key economic developments this week. So let's start first with the easy one. Today we had the April jobs report showing job growth of 428,000 new jobs added in April, above economists' expectations of 400,000. So a good sign that the economy continues to remain strong, even as ugly as the stock market has looked. Okay, when we look under the surface at the economy, we still see good, strong underlying trends. On Wednesday, we had the much anticipated May Federal Reserve meeting where, as expected, the Fed raised interest rates again by 0.5 percentage point. Okay, there was a lot of speculation that they might go 0.75%, a full 1%. At the end of the day, they went with the more dovish policy position, if you will, easy money position by raising less than anticipated. And also, the important thing here was that they laid out their path for the next couple meetings, and they took some of the larger interest rate increases off the table. So there was some fear in the market that the Fed would go too far and too fast. Now, whether or not they go too far remains to be seen, but it does not appear that they are going to do it too quickly. So now, when we look at the markets, like I said, dizzying ride for investors. Okay, here is the last several months, right? We have a very, very wide and volatile trading range that has emerged, right? And the top and the bottom of this trading range tend to act like magnets, right? We moved up and hit into our resistance points several times. We've retested the bottom. We've come back up to retest the top, back to the bottom, right? And investors going along for the ride are probably ready to pull their hair out at this point. And quite honestly, folks, we don't blame you. So how can we stay calm in times like this? Well, the first thing we have to remember, right, like the great Warren Buffett said, that stocks are not a lottery ticket. Okay, they are a piece of ownership in a business. And when price fluctuations get you down, let's take a look and remember that we own businesses. And if those businesses are still great businesses that are growing and performing well, the price will eventually correct itself, right? We have to make sure that the reason we bought these companies in the first place still exists. And in the case of the companies that we own, and many other companies in this market that we don't own, they are still great American businesses. Their stock prices, are just not reflecting that right now. Now, in our macro view of the market, okay, let's zoom out, right? Because as investors, sometimes we have to zoom out. We get consumed with the 6 inches in front of our face. We can't see the forest from the trees, and we let fear grab hold of the wheel. That's not what we're doing here, and that's not what we're going to let happen to you. So let's look at the market. Okay, markets come a long way off the March 2020 lows. Now, when you look at the correction in this perspective, right, doesn't look so bad, but everybody right now is just focusing on the last few months, right? So here's the last 6 months, not very fun. Here's the last 3 years, much better view for investors. So about a couple weeks ago, I think it was May, let's call it April 4th, April 5th-ish, when the market could not break through the overhead resistance that we talked about, we felt that it was a likely scenario that the market would go down and find a floor somewhere around 4,000 on the S&P 500. Okay, so remember, our previous all-time high was about 4,800. 4,000 takes us to about a 20% correction. Now, 4,000, 3,950, give or take, right? You could throw a dart within that range. That's the shaded box represented here. Folks, we are very, very close to those levels. Now, some of you had asked me at the point that I had said that was a possibility, why don't we sell everything and wait for that to happen? Because, folks, in markets, there's no guarantees. We could sell everything. Markets could continue higher and never look back, right? Remember, March 2020, we made a V-shaped bottom and we never looked back. Now, V-shaped bottoms are not normal. We usually get a lot of backing and filling like we're going through right now. but that is why we didn't sell everything. Now, we look for clues in this market, things that we call positive clues, positive divergences, right? Where there are clues or tells underneath the surface that are pointing in a different direction than the overall market. And I'm going to take you through a couple of those here right now because we're seeing positive divergences in this market that would suggest that a bottom is near. So let's look at it. I'm going to bring up a different chart here. Okay, here is the NASDAQ, right? NASDAQ is the chart in the middle. And overlaid on this chart, we have two of our technical indicators that we rely on very heavily. The first one is up top, this blue line, RSI stands for the Relative Strength Index. And on the bottom, we have the MACD, which is the Moving Average Convergence Divergence. I'm not going to bore you to tears and explain what each of them are, but they're very important technical tools that we use in our work. So, how do we use them? We look for clues, tells, if you will, where the data suggests something that the market is not currently showing us, okay? So what we have here is a scenario where we see a positive divergence. And a positive divergence is when the market is making a new low, but these indicators are not in agreement with what the market is doing, right? So we go back to the initial bottom that we saw around March 15th and the strong rally that came off of it. The clue at that point that that was coming was the market was making a new low, but here was the MACD was making a higher low, and our relative strength index was making a higher low. And that's what these lines here depict on the chart. Okay, what did we get right after that divergence? We had a very strong rally in the market. Unfortunately, the market was not able to make it through this critical resistance area that we spoke about at that time, and we made a few efforts to get through it, just couldn't do it. Not enough momentum in the market, and back down we go, like a magnet back to the bottom end of the range. So again, here we are this week. Market's making new lows, but our moving average convergence divergence is making higher lows, and our relative strength index is making higher lows. So folks, these are very important clues. This is what brings about some of the optimism when we say, hey folks, we think a bounce is coming, we think a rally is coming. This is not a guessing game for us, right? This is a vocation we take very seriously, and these are some of the clues that we use. So this is something that bears watching. This would suggest to us that at least in the short term, markets should find a bottom, should find some footing, and we should get a rally off of these levels. So these are some of the things we talk about when you hear me say a positive divergence or clues in the market. Another thing that we're noticing is the internals of the market have improved dramatically, right? So when you look at the S&P 500, right, 500, there's actually 502 companies in it, an extra 2 snuck in there, but let's just call it 500 companies. You go back to a month ago, and the number of companies out of that 500 that were making new lows was about 460, okay? That number has dramatically improved to the point now where we only have 240 companies out of the 500 making new lows. Now, that sounds like a bad thing, right? A lot of companies making new lows. Yes, but it's an improvement, which would suggest that even though the markets, right, the markets made new lows, a lot of the components in the indexes did not make new lows. And how this could be happening, right? People say, well, how could the market go lower if most of the stocks are not going lower with it? Well, this week we saw the mighty few, the tech titans, the Apples, the Amazons, the Googles, the Microsofts. They came under selling pressure this week. And because they make up such a big component of these indexes, they kind of pull down on price a little bit. So that's something important to note. Another thing important to note, folks, is that these corrections have stages, right? In the first stage, they come for the troops, right? Those are your average market participants. And we saw the troops have already been blasted. These are the average small and mid-cap companies in the market. The last stage of every correction, they come for the generals. Who are the generals of the market? These are the Apples, these are the Amazons, these are the Googles, Microsoft, and the list goes on, right? And that's the group they came for this week. So again, sounds like a bad thing, right? Hey, they're coming for the good stocks. Folks, that's the last phase of a correction. If this was a crash, a systemic collapse, the generals would have gone first, and they didn't. They went last. They held on the longest. And that would suggest to us that this correction, this drawdown, this crash, whatever you want to call it, is probably in the 8th or 9th inning here, right? So good things, and that's something that we want to point out to you because you won't notice that reading the Wall Street Journal or watching CNBC. They're not going to talk about this type of technical work, but we want to give that perspective to you. Another thing that we think is very important, a big dislocation in the market, is you have a lot of companies that currently are trading below their cash value. Okay, so that literally means, folks, that when you take their market capitalization, which is computed by the number of shares available and their stock price multiplied, their market cap has gone lower than the amount of cash they have in the bank, right? Now you're probably asking yourself, if a company has $1 billion or $5 billion cash in the bank, how could the company only be worth $3 billion? Great question. That is a market dislocation, and that is something that will correct itself. And those are the dislocations that we want to take advantage of. It also speaks to the irrationality in this market, right? We have companies trading for less than their tangible book value. These are screaming buying opportunities, but right now, right, investors can't see the forest from the trees because everybody's zoomed in and all they're staring at is the last couple weeks, the last couple months, and they're losing sight and feel of fundamental investing. So again, this is just the biotech index that we're showing you here, but this story is true across many market sectors where companies have more cash on hand than the valuation that's being tagged or given to their company in the market. So those are dislocations, and we plan to take advantage of them when we think the coast is clear. Another big problem, clearly, that we've been dealing with in this economy is inflation, right? Inflation is far too high. The Fed acknowledged that the other day, and they are committed to getting it lower. And the concern here for the markets, right, is if inflation keeps going up and up and up and up and up, the Fed is just going to go willy-nilly and continue to hike rates to some unseen or unforeseen amount that's going to be far higher than the markets anticipated, and it's going to be bad for markets. Okay, so now that you understand the problem that inflation causes, here's one of the clues that we look at as a leading indicator of inflation, the Manheim Used Vehicle Value Index. Okay, now clearly this chart went up to the right like a hockey stick for the better part of the last 6 months as used autos started to surge. Well, we have now had 3 consecutive months of declines, and while it doesn't look like it because this chart was so blown out over the last couple months, this index has actually just recorded the biggest 3-month decline in its history of tracking, right? So again, as a leading indicator, this would point to the fact that inflation is starting to peak, it's going to start to roll over, and what that's going to do for financial markets, it's going to ease the pressure on the Federal Reserve to continually hike rates to keep ahead of inflation, because if inflation is going to start coming back down to earth, the Fed will have a much more patient approach. So, and Jay Powell did give a nod to that on Wednesday. He says we are seeing signs that inflation is moderating and starting to peak. Now, obviously, our Fed has a little bit of a credibility problem right now, right? Because they told you for the better part of 2021 that inflation was transitory until they said, whoops, just kidding, not really transitory. We got to get our arms around this. So the Fed makes mistakes too. We think that, that was one of their mistakes that they will correct. But nonetheless, this is something that we wanted to point out. So here's a couple things I wanted to address, questions, comments that we've gotten from folks over the last couple weeks, months, etc. And just as an aside to this, we love the questions and comments. If there's anything on your mind you want me to address in a video, please just let me know. Happy to do it. So first question I got from somebody is, Mike, are you just always optimistic, right? Are you just permanently bullish? Are you evergreen with your view on the markets? And the reality is, folks, absolutely not. Some of you have been with us for many, many years. You remember periods when we were negative, we were bearish, we were out of the market, we were selling stocks, we were raising cash. We will do whatever the situation warrants to do the best for our clients and to get the maximum returns for our clients, right? So in this environment, okay, I don't have to be optimistic if I didn't see the reasons to be. And when we see these types of market dislocations where companies are trading below their cash value, where earnings continue to grow, that was a point I wanted to make. Folks, earnings, we're 80% through the current earnings season. Earnings have not only maintained from last year, they're up 10% over last year. Markets don't top until earnings top. Remember that. Say it over and over in your head when you're getting scared about the volatility in the market. If companies are continuing to perform and earnings are continuing to grow, this dislocation between how companies are behaving and how the market is behaving will correct itself soon enough. So, no, we are not evergreen or overly bullish, always bullish, perma bulls, whatever you want to call it. We will be negative when the situation warrants. We will be bearish when the data suggests that that is the right thing. But that is not where we are at in the cycle right now. And again, it's our job to pound the table, to lean in and say, hey, this is what we see. These are the dislocations. And while we wait for the market to figure out that it has overdone it with the pessimism and downside activity, we will continue to accumulate good companies, shares of good companies, which will reward us when this all blows over. Another question we got was, why is the market so erratic where one day it loves the news, the next day it hates the news? And more importantly, right, who is, quote, the market? Because you hear us talk about it, you hear the financial media talk about it. The market likes this, the market hates that. And somebody asked us, well, who is the market? Is it just a bunch of people behind a smoke screen pulling the levers in the market? And obviously, there's not one singular person or one group of people that move or manipulate the market. But the reality is large institutions have a big footprint in the market and they have an outsized impact on the market, right? I mean, it's simple math, folks. If some firm, some large, BlackRock, State Street, Fidelity, you name it, if they're running 20, 30, 40 billion dollars in a fund, clearly they're going to have more of an impact on the market than somebody with $5,000 in a Robinhood account. But it's the collective movement of investors that make a market, right? The net difference between buyers and sellers. Some days, some months, some years, right? We have far more buyers than we have sellers, and markets just go up and up and up and up. And sometimes in periods like this, the sellers emerge, they reign supreme for short periods of time, and we have far more sellers than buyers, which depresses price. So when you hear us talk about the market, what the market likes or dislikes, we're speaking about it in aggregate in terms of what we see in money flows, what are big institutions doing with the money, both in the short term and the long term. And yes, sometimes these short term moves can be very dizzying, right? Here's a great example of that. Here's the last 5 days in the S&P 500, folks, right? We did a lot of work to end up nowhere, right? We had the Federal Reserve. We came in on Monday at basically, let's call it 4130 on the S&P 500, and we went out at 4123, right? So a ton of movement, a ton of volatility, an extremely wide trading range, almost a 10% wide trading range, and markets went absolutely nowhere. Now, you look at this big spike and then corresponding drop. The Fed raised interest rates right here. Markets loved it. They took off to the races. Then the next day, markets hated it, right? The reality is, folks, not much really changed from day to day, right? It just takes market participants, institutions, and of course, there's a lot of algorithmic trading in this market. It takes them some time to read through the notes, figure out what the Fed's going to do, and make an assessment based on that. And sometimes, folks, you just have what we call a void of buyers, right? Again, we're optimistic on the market. We're bullish on the market over the next 6, 12, and 18 months. We weren't buying any stock today or yesterday or Wednesday because sometimes when volatility is extremely high, the best thing to do is nothing. Remember, investing is 10% doing and 90% waiting. And a lot of people think it's reversed. They think they always have to be doing something, buying something, selling something, trading something. That's not the case. So again, sometimes there's an imbalance. Right now, we have an imbalance of more sellers than buyers because these are people who are panicking, who maybe are a little bit over their skis. They need their money tomorrow, and they just want to get out. They don't care about the price. So again, the moves can be dizzying, but this is a great example where there was a lot of angst, a lot of volatility, and at the end of the day, you could have closed your eyes last Friday and opened your eyes today. Market's in the same exact place, right? So markets tend to put maximum pressure on investors towards the end of these corrections, towards the bottoms of these corrections, and we think ultimately that will be true here. But again, folks, let's zoom out. Let's remember where we've been and where we're going, okay? These markets can give us amazing rewards when we're patient, and sometimes they tend to beat us up a little bit in the short term. We think this time will be no different. And another point I wanted to bring up, question that we had from one of our folks here, one of our viewers, and said, look, Mike, I know history is a guide, and you have all the data and the charts and the technicals, but this time is just different. Right? That's what I've been hearing a lot. That's what not just myself, other folks in the investor community from their clients. That's what every investor is saying. And folks, you know what? The scenes may change, the players may change, the music may change, but the cycles do not. So yes, the reasons why the market are going down this time may be different. This time it's a war and it's inflation and it's, some economic policies that don't seem to be gelling with most of Americans. However, that may be the current environment, but there's always going to be corrections and there's always going to be a reason to point back at as to why it happened. Folks, sometimes markets just need to correct. If you learn nothing else from these videos and what we talk about, here's some simple math that I never want you to forget. once every 2 years, the market's going to drop 10%. That's what history suggests. And once every 4.5 years, it's going to drop 25%. That's all you need to know, folks. You don't need to know anything else beyond that. As far as the why and the how and the who, there'll be opportunities when those times come for us to point out a particular reason or why it might have happened. But maybe, just maybe, the market needed to correct because it had more than doubled off the March 2020 low. Okay. And again, we all love the bottom in March of 2020, nice V-shaped bottom. We never look back. But, that's kind of the exception, not the rule. Bottoms tend to be very messy. They tend to be choppy. And I know I've used this phrase many times before, but folks, corrections have two goals: wear you out and scare you out. The market is not your friend, right? If the market was easy, everybody would be rich, everybody would be retired. It's not, right? And those of you that have been through this before, which is many of you, right? We know every correction feels the same. It starts, we don't know, we never saw it coming. People will tell you after the fact that they saw it coming, but they've also predicted it for the last 10 years. So these corrections start, they hurt, we suffer from recency bias, right? We see the market going down, we assume it's just going to keep going down until it hits zero. That's not the case, folks. That's not what's ever happened before, and that's not going to happen here, and it's not going to happen again in the future. But we know when you're going through it, when you're riding through the storm, it can be difficult. So this is, make no mistake about it, it's a very difficult market. This is one of the most challenging environments we've seen probably in almost 20 years. Okay, the volatility has been extreme. It's like a Category 5 storm. But it's time. It's white knuckle time. Time to hold on, remain seated, keep your seatbelt on, because we will get through this. And when there's better days ahead and we actually get there, we're all going to look back and say, man, what a ride that was. But we're glad we did the things that we did during that period of time. So we covered the markets. We covered the cash on the balance sheet. We talked about the used vehicle index. And we will end with one little anecdotal piece, which we found to be rather interesting. So for those of you that watch CNBC, right, you know that when markets get rough, they do something called a markets in turmoil special, right? And it's kind of become a running joke in finance that, when markets get ugly, we're all rooting for the markets in turmoil special, because that usually means a bottom is very near. And one of our friends through Twitter, actually, Charlie Bellello, actually compiled the data to say, let's look at the forward returns for the S&P 500 following CNBC firing up the old markets in turmoil special. And, obviously, folks, we're not going to trade based on this, but there has never been a more reliable indicator in this market for forward returns, positivity of forward returns, than CNBC running a markets in turmoil special. Would you look at these numbers, folks? Now, again, this data spans back all the way to 2010 and periods of time, 2010, 2011, 2015, 18, 20, right? All the different times where markets really got ugly, people really got scared, and the media's got to jump on it and fan the flames of fear, because that's what sells. So they run the markets in turmoil special. 100% positivity rate from when CNBC runs this special. 12 months later, markets are higher every time that it's ever happened. So again, just something to kind of chuckle at, a little anecdotal evidence here that, bottom may be close. They just started running the markets in turmoil special last night. So we'll, remains to be seen if this time will be as evergreen as previous times. But the moral of the story, folks, is, we want to convey to you, we do see some clues in this market that a bottom is close. We are seeing those positive divergences, right, where the internals are improving even as the market looks like it's getting weak. We are seeing that we're coming right into that critical level that we spoke about, right around S&P 4,000. So again, this is not fun. It's been tough on investors. Markets are applying that maximum pressure, trying to see who's going to break. But like we've said before, and we'll say it again, not here, not now, and not our folks. Not going to let it happen to you. Keep calm, invest on. We're going to get through this. If you have any questions, please reach out to us. Like I said, comments, concerns, questions, if we want, we can address them in the video. We love to do it. Reach out to us. Anything that's on your mind, give us a call, send us an email. We'll be here for you every step of the way. We hope you have a great weekend, and we'll see you back next week for the Heritage Market Update.